All right. Today is Tuesday, July 27th. Folks, I was planning to do a show, but I decided to concentrate on my mental health. So, good night. No, I'm just kidding. But what a shame, huh? Our athletes have the luxury to take breaks, to concentrate on their mental health. Because they're multimillionaires. But you know who doesn't have the luxury to concentrate on their mental health? It's those Russian kids. Because they're told, you go get gold medal or you die. All of a sudden, they're performing miracles on the floor mat. You know, because they're not making millions filming commercials with Tony the Tiger. They're actually hungry. That's the key word here, folks. Hungry. They're not bloated with cash. Therefore, they have to perform. And that leads us to the stock market. You see the segue? Who's bloated and not hungry to perform? Big cap technology stocks. After the bell, we got plenty of earnings, a slew of earnings from big cap technology stocks. And guess what? They crushed it. Across the board. Beats across the board beyond expectations. The earnings were pristine. Beyond pristine. So why aren't these stocks popping higher after hours significantly? We go back to the issue of being bloated and not hungry to perform. We're talking about the stocks, not the companies. Let's go over some of these earnings so I can illustrate to you how massive these beats were. Starting with Microsoft, the stock was down about 2 to 3% after hours, and then as the call started, the conference call, the stock did a 180, and now it is trading in the green again. So we're going to see developments as we continue to hear from these conference calls, and of course the reaction will be different as we start a new session tomorrow. But take a look at Microsoft's earnings, for example. The revenue year over year was up over 21% for the quarter and up 18% for the year. Likewise, net income, pay attention here, was up 47% year over year. Folks, we're talking about a company with over $1 trillion valuation. This is one of the largest companies in the world, and it is growing 47% net income year over year. Massive numbers. Now, let's look at the different categories for Microsoft. Double-digit growth across the board, with exception of Windows, Xbox, and the Surface products. That's understandable due to the chip shortage. And of course, the majority of buyers already bought their laptops, their tablets last year. So that was expected. The drop was expected in the Surface segment. Yet you take a look at some of these numbers. Office 365 growing 20% year over year. LinkedIn 42% year over year. Azure, the cloud business, growing 45% year over year. Massive growth numbers. Now, let's talk about Google, the big Goog, Alphabet, our beloved and dear employer. We all love Google, of course. The stakes were too high for this name because it has been the overperformer within the FANG names, the big cap technology names, gaining over 50% year to date. So this was the one stock that was under threat of dropping down big if these earnings didn't come out pristine. And they indeed came out pristine, more than pristine. And you saw the stock trading higher after hours. We will see what happens tomorrow. Could trade down, but regardless, these earnings are extremely impressive. For example, the revenue growth year over year, 62%, even more than Microsoft. The net income growth, more than doubled year over year. This is insane, more than Microsoft's growth. And of course, this is all attributed to the YouTube segment. YouTube grew from $3.8 billion in revenue last year to about $7 billion in revenue this year for the quarter ended in June 30th. Massive growth for YouTube, and rumor has it that there is a certain YouTuber by the name of the Maverick of Wall Street who was single-handedly responsible for increasing the revenue of YouTube. But even Google advertising grew from $30 billion last year for the same quarter to over $50 billion for the same quarter this year. Massive growth. Now, let's take a look at Apple, for example. When we look at their sales, the revenue, the growth year over year from about $46 billion to about $64 billion. This is for the products segment. This is growth of over 30% year over year. Once again, we're talking about the largest company in the world. Likewise, the growth for the services segment grew by over 30% year over year. The net income year over year almost doubled. Massive growth for the company. Let's take a look at the different geographic regions. Growth in the Americas, Europe, even China. We're a little concerned about Chinese growth, and now we have the answer. The growth in China is still intact. Likewise, there is growth in Japan at a slower rate, of course, but when we look at the categories, we knew that the iPad and the Macs will slow down a little bit in terms of the growth rate, and this is exactly what we're seeing, along with the wearables segment also growing, be it at a slower rate than the iPhone, for example. And then we have the services segment growth. The services, this is the shakedown money for the iMob. You know, you pay us the rent, the 30% rent, the cut. Otherwise, we'll break your kneecaps, we ban you from the store. And the shakedown segment also growing significantly year over year. Now, let's take a look at AMD, for example. You thought Google was impressive, huh? Take a look at this one. AMD, the revenue growth, year over year, 99%. Almost doubling the rate of growth from last year. And this is perhaps the most impressive earnings report so far this season. We talked about the revenue doubling year over year. And if you thought that was impressive, take a look at the net income, up 352% year over year. Once again, 352% year over year. Absolute insanity. It looks like fraud. It doesn't look real. But it is real. This is how fast growing this company is. Now, let's take a look at different segments of AMD. Computing and graphics, the revenue is up 65% year over year. And then we have the enterprise segment, up 183% year over year. And this is contributing to doubling the net revenue growth year over year, all in all. But again, if you thought this was impressive, take a look at the balance sheet for AMD. They have increased their cash position by over $2 billion year over year, and they managed to cut their debt down. Significantly so. They managed to cut the debt by more than half. This is perhaps the best earnings report so far. So here it is. Microsoft, impressive. Google, impressive. The iMob, impressive. AMD, more than impressive. So why aren't these stocks moving significantly higher? The answer is, and perhaps you got the answer from the Souffle's earnings yesterday, Tesla's earnings, reporting $1 billion in profits. No funny business, no environmental credits. They're actually making profits by selling actual souffles for the first time ever. So why is the stock trading down today? Well, when you take a look at the forward PE, this is the forward, not the lagging PE, meaning that all of this future growth already factored in. We have bloated valuations here. We don't have that hunger to push these stocks higher. The forward PE for Microsoft, 34, Apple, 27, Google, 27, Facebook, perhaps the cheapest one here, 24, AMD at 33.5. Take a look at Amazon, 50. And if you thought that was crazy, Tesla at about 104 forward PE ratio. Absolute insanity. All of this growth is already accounted for, and therefore these stocks are struggling to move higher. Here's another metric, the price to sales ratio, which is more generous, by the way, than the forward PE. Microsoft at 13.5, Apple at 7.5, Google at 9, Facebook at 10.5, Amazon at 4.5, perhaps the cheapest one from this metric alone. And then we have Tesla at 17.5, the most expensive stock in the NASDAQ when we talk about big cap stocks. So once again, we go back to the intro. These stocks can afford to take a break. They're already bloated. All of this growth is already accounted for. They don't have to show us anything. The stocks can just trade sideways and do nothing at all. Meanwhile, the lagging stocks, the not so hot so stocks, when they beat revenue and earnings estimates, they trade higher. The likes of Raytheon, GE, Triple M, unloved sectors of the market. And this is the message of the day. Now, we have a lot of news today. Matter of fact, too many news. Excuse me. What am I, a moron? Too much news. And therefore, we cannot just squeeze it in this video. We have to do the headlines of the day segment because we continue to get more information regarding the Chinese crackdown. Is it over? How widespread will it be? Will it include EV manufacturers like NIO? You saw NIO trading down significantly today. Will it morph into an attack on US-based companies, the likes of Apple, Starbucks, and Tesla? We also had news about the flip-flop from the CDC. They said, oh, if you're vaccinated, you don't need to wear a mask. Now they're flip-flopping again and saying perhaps you want to wear a mask even though you're vaccinated. And next thing you know, they're going to say, oh, perhaps we need a third shot, a booster shot. First, they said you don't need a shot. In the next few days, they're going to say, oh, perhaps you need a shot. And this flip-flopping is confusing the market and everybody else, the vaccinated and the unvaccinated alike. We also got news, macroeconomics news, the Case-Shiller Home Index, for example. What a number. Yet the Fed continues to say, oh, it's going to be transitory. Have some hope and faith and let's hold hands and pray that it's going to be transitory. Meanwhile, we have the IMF, the International Monetary Fund, saying that perhaps, admitting, by the way, not just saying, admitting that perhaps inflation is not going to be transitory and it is more persistent. Prepare to hear this word over and over again. Persistent. But again, we will cover all of that and a lot more in the headlines of the day video. For now, we're moving on to cover the market's information, and here we go. The Dow Industrial Average closing in the red, down 48.67 points, or a decline of 0.24%. The Nasdaq down 180.14 points, or a decline of 1.21%. The S&P 500 down 20.60 points. That would be wild if it was down 20.60%. It was actually down 0.47%. What about the sector's performance today? Leading the pack at number one and capturing the gold, the silver, and the bronze. Utilities. We have an extremely defensive tone in the market today. The most defensive sectors of the market led the action today. Utilities, real estate, and defensives. Meanwhile, the laggards of the day, the offensive sectors of cyclicals, communication services, and technology. But what about the advance to decline ratio? Bad, very bad. NYSE, 27% advancing versus 70% declining. The Nasdaq, 24% advancing versus 73% declining. Awful breadth for the market today. What about futures? What's going on here? Muted action for crude oil Brent and WTI all closing on the flat line. Meanwhile, in softs, lumber continues to drop, struggling to create a rally here, yet maintaining the 550 level for support. Coffee futures, massive rally as of late, up over 30% in less than a month. But now it is taking a break, down by about 1% or so. We have cocoa and sugar futures on the flat line. Meanwhile, gains for cotton and OJ futures. Watch out for the stealth rally in OJ futures, riding high by the tune of about 4.20%. And the reason behind the stealth rally in OJ is the weather conditions in Brazil. The same conditions leading to the rise in coffee prices are also leading to the rise in OJ prices. The largest producer in the world for coffee and OJ, the country of Brazil, a critically important country. It pretty much feeds the world, but it is in a political chaos. They're still struggling with the COVID-19 crisis, and now we have, on top of that, the weather phenomenons adding more pressure on supply chains and crop outputs. What about metals? Declines across the board. Silver, platinum, copper, palladium, all trading in the downside. Meanwhile, gold closing at the flat line. Gold is watching the US dollar like a hawk, waiting and waiting and waiting for the US dollar to drop before popping higher, and vice versa. If the US dollar pops higher above 93, then gold will decline sharply. And tomorrow is the day. Whatever the Fed says, we will have the finale in the standoff between gold and the US dollar. What about meats? Modest declines across the board for live feeder cattle futures and lean hogs futures. Watch out for live cattle futures here to rise higher. And the reason is the shortage of hay. We have extreme weather across the country, and ranchers are resorting to culling their herds. That is a fancy way of saying killing their cows. And therefore, we're going to see a shortage of beef and milk, pushing prices of these commodities significantly higher. What about grains? Muted activities across the board, with exception of soybean meal, rising higher by the tune of about 1.5% today. Oats futures also on a steady rise higher. We talked about the lowest output of oats crops since 1866. The tailwinds are here, and they're going to be here for the foreseeable future for oats prices to continue to climb higher. Moving on to the big casino, the options market. What's going on here? The tables are empty. It's a ghost town in the casino. Everybody's scared and afraid of making massive bets. They've been chasing the move ahead of time, betting these big cap technology stocks higher every day, and now we have buy the rumor, sell the news phenomena. And you can see the moment the support of the casino is lifted from underneath the market doesn't climb higher, meaning that the recent rally in the stock market was fueled by options speculation, specifically from the retail side, you and I. Yet Apple remains at number one, with about 870,000 contracts. About 66.5% of those were calls. We were talking about 3 million contracts per day just last week. Now we're down to 870,000 contracts. At number two, Tesla, the souffle, with about 700,000 contracts. 53% of those were calls. And number three, Alibaba. What a shellac this name has got, along with other Chinese names. Who knows what Chairman Xi is thinking about, but he is crushing these Chinese companies. He is crushing his own companies, and Alibaba was one of those companies that got crushed since the crackdown started. But, and this is the big but, perhaps we're going to see a technical rebound in Alibaba. So if you bought call options with the expiration date of this upcoming Friday, you're not that dumb, by the way. You actually did the right thing from a risk versus reward perspective, that we're going to see some short covering by Friday and Alibaba should rebound a little higher. It's a shot, it's a lottery ticket, it's a gamble. You're not going to put your retirement money in this trade. You're just going to commit a little amount of money for a wild shot to hit. Alibaba, number three, with about 500,000 contracts traded for the name today in the options market. About 60% of those were calls. And by the way, where is AMC? Ape Land is not here. What happened to the apes? They're not supporting their jungle. The volume for AMC was just shy of 200,000 contracts. Massive drop for the name here. And the reason is the majority of retail traders are chasing these Chinese names via the options market. Speaking of, let's move on to the unusual trades that took place in the options market today. Lots of gambling here on the Chinese names, the Chinese stocks. I'm going to try to avoid a lot of them, but pretty much the majority of action today in the casino was regarding these Chinese stocks, so it is extremely hard not to talk about them. Starting with the ticker FXI. This is a China ETF. In this trade, they're buying puts, betting for more downside to come for this ETF. By buying the 37 puts, expiration date August 6, with expectations that the name will drop by over 5% by then. They paid about 65 cents a piece to enter this trade. All in all, spending about $5.5 million for this trade. What about the ticker ASHR? This is yet another Chinese ETF. They're betting for more downside to come here by buying the 34 puts, expiration date August 20th, with expectations that the name will drop an additional 6% or so by then, and they paid about 60 cents a piece to enter this trade. All in all, spending about $1.6 million. What about the trade for the ticker CVS? For, you guessed it, CVS. Perhaps this is an earnings play because they bought the 90 calls, expiration date September 17th, with expectations that the name will rise by over 8% by then. They paid about 75 cents a piece to enter this trade. All in all, spending about $1.5 million. When you actually dig into this trade, it is probably somebody who holds the stock and they're selling upside calls to raise cash. What about the ticker BEKE? This is yet another Chinese name, KE Holdings, and as far as I'm concerned, Cathie Wood, Mama Cathie, dumped the name. You'd think that Cathie Wood will actually buy the dip in these Chinese names, when in fact she's dumping these names. And somebody's betting for more pain to come in this name. It's already down over 50% year to date, and somebody is betting for more declines to come. By buying the 20 bucks puts, expiration date August 20th, with expectations that the name will drop by over 17% by then, and they paid about $1.50 a piece to enter this trade. All in all, bringing the total to about $2.5 million. What about the trade for the ticker ROKU, Roku? They're betting for more upside to come here. This is perhaps an earnings play. Once again, you can read it as a stockholder selling upside calls to raise cash. Yet again, it could be a speculative bet that Roku will pop higher after earnings. In this case, they're buying the 500 calls. Expiration date July 30th. They have 3 days for this trade to work out. They're expecting the name to rise by over 10% by then. They paid about $2.60 a piece to enter this trade. All in all, bringing the total to about $3.7 million. Continuing with interesting trades. What about the ticker TAL, TAL Education? This is the poster boy for the crackdown by the Chinese Communist Party. The name is down over 90% year to date, but yet rebounding higher on a technical, mechanical pop, rebound, whatever you want to call it, short covering, that works too. But here we have somebody betting for more declines to come, perhaps delisting for the name, because they're buying the $5 puts, expiration date August 20th, with expectations that the name will drop by over 10% by then. They paid about $1 a piece to enter this trade. All in all, spending about $800,000. What about the trade for the ticker Alibaba? The ticker BABA for Alibaba. Somebody's actually betting for more declines to come. The rational trade will be betting for a rebound to come. But another way to look at the trade is the seller point of view, because somebody's buying these, the 175 puts, but on the other side of the trade, somebody is selling those puts. The 175 puts, the expiration date is July 30th, meaning this Friday. So if Alibaba pops higher, the seller of this trade will capture the credit. Meanwhile, the buyer will lose the entire amount. In this case, the buyer of these options is expecting Alibaba to drop by an additional 5% or more by Friday. They paid about $1.50 a piece to enter this trade. All in all, spending about $1.2 million. Lastly, what about the trade for the ticker NIO? A lot of you guys love this name. You own it, you trade it, whatever it is. But watch out here, because next thing you know, the Chinese Communist Party will crack down against EV manufacturers. But here we have somebody betting for a rebound, at least in the short term, by buying the 42 calls, expiration date August 6. They have 10 days for this trade to work out, and they're expecting NIO to rebound by over 7% by then. They paid about $1.40 a piece to enter this trade. All in all, bringing the total to about $700,000. Moving on to the heat map analysis. What's going on here? The technology sector is getting whacked with very few exceptions. And then we have the Chinese names also getting crushed. Alibaba, Pinduoduo, JD, all trading down significantly. And this time around, the EV manufacturers are joining the party. NIO, Xpeng, Li Auto, all trading down severely. What's working today are the defensive sectors of the market, the extremely defensive sectors of the market. We're talking about the dividend-paying names, so to speak. Utilities, REITs, consumer defensives, even the healthcare sector, by the way, managed to outperform significantly today. The reasoning behind the underperformance of the healthcare sector on paper is the underperformance of biotech stocks. These are the hot names, the risky names, the Modernas of the world, high valuations, high multiples. They underperform when the market is in a de-risk mode. So once again, as an investor, we're not sure how long will this storm takes to pass. The Chinese crackdown, the Fed uncertainty, the inflation uncertainty, the Delta uncertainty. So parking some cash in these dividend-paying names, the safest stocks in the market, in the consumer defensive sector, REITs, utilities, healthcare, all of these sectors of the market will offer you some sort of protection. If the market goes down altogether, they'll go down too. If the indices get sold off, the SPY, the NASDAQ, they will go down too. But the magnitude of the drop, the magnitude of the pain will be a lot less than, say, technology, financials, cyclicals. And I am personally starting to like the drug manufacturers here in the healthcare sector. And the reason is we have Delta concerns, the CDC's flip-flopping, you don't need masks. Now you need masks. Next thing you know, you don't need a booster shot. Oh, now you need a booster shot, and this will be good for Pfizer, Eli Lilly, Johnson & Johnson. All of these names will outperform here. I'm a little concerned about Moderna because Moderna is already trading way higher in the stratosphere, and a safe and simple strategy to get involved in the healthcare sector right now is buying the ETF, the XLV. That way you have exposure to Pfizer, United Health, Merck. You're not dependent on one company. Moving on to charts, starting with the SPY 30 minutes chart. Once again, the SPY was trading at all-time highs. A bullish formation. The sky's the limit. Everybody's jerking off to the chart. Look at the bounce, bro. We got it, Papa Jerome. But I gave it the thumbs down because it was garbage to begin with. It was highly extended, highly speculative, mainly based on options trading. And what do you know? We're gapping down in the morning. The SPY cracking below 438. The good news is it managed to recapture 438 for support once again by the end of the day. And the reason is, yes, technology is down, but you have utilities, defensives, healthcare, even financials and industrials not doing so bad today. So the SPY, the magnitude of the drop will always be muffed unless the market goes down altogether. The chart went down all the way, almost closing the gap in the yellow bubble. We're not going to make a big deal out of it. Matter of fact, reversing before closing the bubble, the gap, is actually a bullish signal that the chart is not ready to go down and it is starting to pull its way higher. And recapturing 438 for support by the end of the day is a point for the bulls. The chart will attempt, keyword attempt, to climb its way back to close the gap and trade at all-time highs again. And this, by the way, could happen overnight via the futures chart. My bet is, even if the SPY tries to trade higher, closing the gap and recapturing all-time highs, it will struggle to do so, and we will see pullbacks, absent of a pleasant surprise out of the Federal Reserve tomorrow. We have Papa Jerome speaking, and if he says, you know what is inflation anyways? Where is inflation? I don't see any inflation. And by the way, we got Delta, and Delta scares the shit out of me, and when I get scared, I go down to the Fed's basement and I start printing. Print, baby, print. That's how I get over my fears and anxiety. Speaking of, here is the daily chart for the continuous contract for the SPY, the S&P 500. The good news is we're still trading above support. We're still trading at almost all-time highs. No major damage at all from a candlestick pattern. The bad news is we still have a negative divergence in the RSI, and the MACD indicator is struggling to maintain its strength. And watch what happens when the volume creeps back in the market. We see red days right away. The market likes low volume, autopilot buying via the algos, options gambling. So your indicators here, number one, the volume. Number two, watch the options market, aka the big casino. If the volume remains muted, Apple trading under 1 million, no activities for AMC, everybody's busy with the Chinese names, then we're gonna see the SPY struggling to pull itself higher. Matter of fact, it could go down, breaking the support of 4,384.5. Believe it or not, the recent rally in the stock market is supported by the options gambling mania via the retail side, meaning us. The institutionals, the smarty pants, the snakes that they are, they're not really buying, they're not making any major decisions. They're just pumping on TV and in social media to get you and I to buy every dip and assume the risk. And now you're seeing, even after these impressive earnings, the big cap technology stocks are not moving significantly higher at all. Some of them are actually trading down. And that leads us to move on to the Qs, the Nasdaq 30 minutes chart. We talked about the resiliency of the rebound and the pop higher in the Nasdaq. It was supposed to pull down at 363. Take a look at the MACD indicator. Every time it's about to cross and lose its momentum, we see dip buyers pumping it higher and higher and higher again. But eventually, it was inevitable for the Qs to break, in this case the MACD for the Qs, to break its momentum, crossing to the downside and creating red impressions in the histogram. Of course, we're talking at a short scope here, the 30 minutes chart. And I gave the thumbs down even though it was a bullish formation. And what do you know? We saw the flush down right away because the move was extremely overextended. When you have overextended moves on low volume, the pullbacks are extreme. The flush downs are big. This time around, the pullback took us all the way down to 360.5. and the Nasdaq managed to rebound from 360.5 and recapturing 363 for support once again. So yes, there is some damage on the chart technically, but it is only taking some air off the massive rebound that we saw recently. This will all depend on the sentiment and the psychology tomorrow. Market participants, and by the way, I'm asking you, you are a market participant after all. Looking at these earnings from Google, Microsoft, AMD, very impressive. But on the other hand, the valuations are extreme. Would you start buying these stocks in the morning tomorrow? If you are willing to do so, and this becomes the consensus, then we will see the Qs rebounding higher and perhaps trading at all-time highs once again. But if the market looks at these earnings, saying, you know what, perhaps we're reaching peak earnings. They're good, but the valuations are extreme. Oh, and by the way, I'm liking names like Raytheon, Triple M, the hated names in the market. This is where the opportunity is. When we talk about inflation, every CEO is talking about inflation, specifically in these giant industrial names. And they're passing the cost of inflation all the way down to the end customer. The technicals are important in this chart, but most importantly is the sentiment. What about the daily chart for the continuous contract of the Nasdaq? More damage than the SPY. We have negative divergence on both the RSI and the MACD indicator, struggling to maintain these elevated levels. And the chart is closing below 15,000. So the damage is more severe and persistent. That's the key word, persistent. Remember, in the Qs versus the SPY. And by the way, I issued this tweet overnight, yesterday. We had a steep bullish trend line. This is the 3 hours chart. The Nasdaq futures were struggling to keep that very steep trend line. It was bound to happen. You just had to be patient, wait and wait and wait. And once you see the chart start to spill over, breaking that steep trend line, this is exactly where you place the short trade. And what do you know? The market opens down severely and you made a quick buck from a trade overnight. In, out, hello, goodbye. And by the way, last Friday, the Nasdaq popped higher, over 1%. But I tweeted this, while everybody's jerking off to the chart, you see we're out of the wood. The Nasdaq is trading at all-time highs. What correction, bro? The internals of the Nasdaq were negative. The advance-to-decline ratio was 46% versus 51%. So the warning signals were there, even as the Nasdaq was rebounding higher, impulsively so. Moving on to the IWM 30 minutes chart. Small caps tried too hard and gave it a good fight to keep 218 for support. We had a double bottom formation, and then it appeared to be a cup and handle formation. And a lot of traders bought calls on the IWM, perhaps it will pop higher off the cup and handle formation. And this was the right call, by the way, but it did not work out. We saw the IWM also gapping down today, breaking the support of 218. Sometimes you gotta take the shot, and sometimes it's not gonna work. Welcome to trading. And by the way, the IWM was actually overperforming the Nasdaq in the morning, slightly, and it was bound to rebound higher from the gap down. But the moment we got news that the CDC is about to update the mask mandate, right away you saw the travel names, the reopening names also going down, and that intensified the sell-off in the IWM. What about the Dixie, the US dollar? It remains resilient, and the reason is it is waiting and waiting and waiting for the FOMC meeting and the conference by Chairman Jerome Powell, which will happen tomorrow. So the pop or the drop in the US dollar will happen tomorrow. This is the most important chart to watch as you hear Federal Jerome speaking. The technicals are overextended, but the fundamentals say if the Fed decides to wake up from its coma and its delusion that inflation is transitory, and perhaps they start talking about tapering this year. Take a look at the Chiller Index. This is insane. The highest on record. Home prices are getting out of whack. Absolutely insane. Pricing the majority of Americans out of the market. People are lining up. These are scenes that we have not seen even during the housing crisis of 2006 and 2007. We've never seen these scenes before. People stampeding to pay over the asking price. People going under the table, offering landlords more than the asking rent price. This is insanity. This is mania, and if it continues, it will pop on its own, and we will see a massive housing crash, which will lead to an economic disaster in this country. So the Fed better wake up and at least start tapering the MBS mortgage-backed securities assets purchasing. But if the Fed is delusional and says, you know what, Delta, it's kind of scary. And when we're scared, we got to keep the printer hot. Print, baby, print. Then guess what? The US dollar will go down. This is at least the assumption. But if the Fed decides to taper, announcing tapering, then we will see the Dixie popping higher above 93. And remember this, Jerome Powell said, I will let you guys know in advance. I will give you advance notice before we taper. The problem is the moment he starts to announce tapering, even if it comes out tomorrow, and he says, folks, we're going to start tapering in September. The market will crash now. So much for advance warning, Mr. Powell. The likelihood is he's going to say we're going to print, baby, print. Delta's kind of concerning. And maybe at some point we're going to talk about tapering, but not right now. And let's get the party started. And the party will be good for gold, because if the US dollar goes down, gold will pop higher. You see, gold has been the mature guy in the room, waiting and waiting and waiting to see what the US dollar wants to do. It's a critical day for both the US dollar and gold tomorrow. It's going to be an inverse move. This is the assumption. Dollar goes up, gold goes down. Dollar goes down, gold goes up. It is also a decisive day for yields. Yields have been maintaining and grinding along 1.28 basis points. Now, the assumption is if tapering happens or announced, yields go higher. But if it doesn't, yields go down as the Fed continues to buy bonds by the tune of $80 billion a month. This is the assumption, but this is not how it worked recently. Matter of fact, when we had tapering fears, yields went down, not up, surprising everybody, including myself. So we will see how yields behave as Federal Jerome speaks. This is the one that I cannot make a call about either way. But the fact that yields continued to hold on at 1.28 basis points, it shows the appetite for yields wanting to go higher. They just need a confirmation from the Fed. And if you are really paying attention to the behavior of yields, you notice that overnight, as the Asian trading is going on and the Hong Kong market, the Chinese market are trading severely to the downside, we see yields going down as Asian investors start to de-risk and move on to the safety, so-called safety, of U.S. bonds. But as trading starts in the United States, we see bonds being dumped and yields recovering higher. So we have this battle dynamic between Asian investors wanting to de-risk, understandably so, and then we have American investors wanting to risk and go ahead with the inflation trade, for example, with the assumption that Delta is not a risk. Delta is just a risk for the unvaccinated. But now we have the CDC throwing a monkey wrench in the mix, saying that even if you are vaccinated, perhaps you want to consider wearing masks again. And that kind of shakes the confidence. What do they know that we don't know about the Delta variant? Is it scary enough to prompt mask mandates, third booster shots, and perhaps lockdowns in certain regions? If that is the case, then yields will go down significantly as the prospects of growth diminish. What about the TLT? What's going on here? This is the inverse of yields, bond prices. We have significant appetite out of Asia buying US bonds. And this is a weekly chart, by the way. The TLT is now trading above 149 once again, and there is plenty of room to go higher from a technical perspective. Now, there is a lot of chatter from technical analysts about a cup and handle formation in the TLT. I don't see any cup and handle formation from this chart at all. The cup and handle formation works as the following. We have a top from which the chart reverses to the downside. At some point, the courageous dip buyers who are willing to take the risk, they start buying this chart, whatever chart it is, and we see a saucer bottoming formation. The chart starts to climb its way higher, all the way to the previous top. At that point, the dip buyers say, you know what, there is resistance here. It's the prior high, the reversal point. We made a lot of money buying the dip. Perhaps it is time to de-risk and take profits off the table. And we see the chart trading down slightly, working its way down. And this is the formation of the so-called handle. And at that point, we see a second batch of buyers, perhaps the not-so-courageous dip buyers, who are watching the action as the courageous dip buyers push the chart higher. But at that point, they say, you know what? Perhaps it is too late. We missed the buying opportunity. We should have bought with the courageous dip buyers. So we're just going to wait and see here. And as we see the handle formation start to happen, those hesitant dip buyers who missed the opportunity to buy, they jump in and they buy the chart and we see the pop higher and therefore the cup and handle formation. When you look at all of these candlestick patterns, cup and handle, bull flag, bear flag, at the end of the day, they mean nothing on their own. They're only explained via the psychology and the sentiment of market participants. Therefore, sometimes you see formations of bull flags, bear flags that never work out. And the reason is the psychology was different. It's a study of patterns of the psychology. A lot of technical traders and technical analysts don't teach you this. They just teach you the pattern. Oh, look at this. This is a cup and handle, bam, it goes higher. This is a bull flag, it goes higher. Bear flag, it goes higher. But you gotta understand the psychology behind the pattern. Moving on to the VIX 4 hours chart. We have another crossing in the MACD indicating that the VIX is about to pop higher. It is grinding its way to reclaim 20 once again. It's a psychological level, the 20 on the VIX, meaning that perhaps we haven't seen the end of the pain in the SPY. How big will this pop be? The last one was 50%. Perhaps this one will be even bigger. It looks very promising from a MACD perspective. So the risk versus reward says the VIX will pop higher and we will see more pain in the SPY. And therefore I'm saying the SPY will attempt to climb its way higher overnight. But my bet is it will fail and it will slide down once again as the VIX pops higher. What about Apple, the big one? 30 minutes chart. There's nothing to look at here. The chart is still trading within range. The support 145, the resistance 150. Now after hours, the chart is trading slightly below 145. If the chart breaks 145, we will see a flush down all the way to 140. There is soft support at 142, but the ultimate destination will be 140. Remember, this chart was bought ahead of the news. Buy the rumor, sell the news, even though the report was excellent. I just showed you the numbers. Growth across the board. The shakedown business of the IMOB is doing phenomenal. But now investors have another thing to factor in, which is the Chinese crackdown. At what point? It's inevitable, folks. The CCP will start cracking down on Apple. It will happen one way or the other. They're not going to just crush their own companies and let American companies pick up the spoils. What about the souffle? 30 minutes chart. What's going on here? We had a series of lower highs and lower lows. The chart was trading below 657, which was or still is the bull to bear advantage line, meaning that the bears had the advantage to begin with. We saw the cute pop prior to earnings. Somebody got the report beforehand. Tesla's making $1 billion in profits, assuming that Tesla will pop higher after hours. What do you know? The reaction was tamed. Tesla was trading about 1% higher after hours. And today, as the market opens, the souffle goes down all the way to the support of 629 and rebounding from that level slightly higher. The assumption here is the bears still have the advantage and they will push this chart below 629. 629 will be broken and perhaps we will see more pain in Tesla's chart. Absent of Tesla bulls conducting a rescue operation and pushing the chart above 657 by the end of the week. Again, impressive earnings, $1 billion in a quarter. Finally, they're making profits from selling cars. The problem is the company is trading at a valuation of $600 billion. So making $1 billion in profit in a single quarter, big deal. It is already factored in. What about tulips, BTC? We had the rumor, and by the way, this is a nasty pumper, who floated the rumor that Amazon is about to trade Bitcoin in one of its platforms, yada yada yada. Regardless whether it's true or false, buy the rumor once again, and we see BTC popping higher, significantly higher, above 35,750. Now, Amazon later that day comes out and say, you know what? All of this news is false. We're not buying tulips. We're not doing any of that. Regardless, mission accomplished. It triggered the short squeeze in BTC, at least for a day. And so far, BTC is maintaining the levels above 35,750. For me personally, I don't want to be in this fight, because the shorts are going to want to short again, knowing that the news about Amazon buying tulips was false to begin with. Yet on the other hand, you have other shorts who made a lot of money. They're getting a little nervous. They have a sour taste in their mouth from one rumor triggering a short squeeze. So who knows what's going to happen here, but BTC bulls have the advantage so long as the chart is trading above 35,750. What about ETH, Ethereum? I'm out of this one. When I saw the pop, I exited at around 2,400. So whoever floated the rumor, it is a pump and dump, it is market manipulation, but thank you anyways, because yours truly made about 20% gains in a couple of days. In, out, hello, goodbye. My laser beams are gone. Now I can see clearly. But the technicals remain positive for ETH to pop higher, perhaps above 2,500. The technicals remain intact. So if you are still in the ride, good luck to you. But for me, it was a trade to begin with. I'm not a tulip kind of guy. I'm not a laser beam kind of guy. I'm an in, out, hello, goodbye kind of guy. What about AMC, A-Plan? No options gambling. No move higher. But the good news is, so far from a 1-hour charts perspective, we have a higher low. And so long as the apes maintain higher lows, the likelihood is they could, keyword could, climb their way all the way to 52. The problem is the momentum is weakening significantly. You don't hear them anymore. The apes. They were loud and clear, trolling in the comments, and now they're gone. But in my opinion, it's not over until 32 is broken. And so far as the chart is trading above 32, there is a lot of hope for the apes to push this chart a lot higher. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? The big event? Federal Jerome is speaking. The FOMC minutes. Is he going to face the music, announce tapering, or will he be in denial and delusional per usual and saying we need to see persistent inflation before we do something? Oh, and by the way, Delta is a problem. This is what we're watching for. What about the earnings calendar? We have Boeing, the flying coffin, Bristol Myers, McDonald's, Facebook, and Ford. The excitement continues, and the only safe bet in the market these days is buying calls on popcorn, because this is popcorn season. With that, ladies and gentlemen, thank you for watching. Thank you for listening. That's all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.